Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be going through 3 of the most attractive looking US dividend stocks on the market right now that you could look to add into your portfolio. And without further ado, let's dive straight into it. The first stock that is trading at a massive discount right now is stock ticker NKE, Nike Inc. They're currently trading at $76.58. They're based in America, part of the consumer industry, have a market cap of $90.46 billion. They went public in 1980, have a dividend growth streak of 22 years, a 5-year dividend growth rate at 9.64%, a dividend yield at 2.09, and a very healthy payout ratio at 45%. As you can see from the 12-month graph, they are actually down 26.49% right now and very close to that 52-week low. Nike is one of the largest sportswear and footwear companies in the world. Known for its athletic apparel, footwear and equipment, the stock's performance reflects the company's business success, market conditions and broader economic trends. Investors often view Nike as a leader in the retail and sports industries. In recent years, Nike has faced challenges including a decline in sales and stock performance, with shares dropping from a high of $175 to as low as $70 lately. The company's brand appeal has diminished, as evidenced by an 8% decrease in secondary market prices for Nike branded products in November. Intensifying competition from brands like Skechers, Hoka and On has further impacted Nike's market position. In response, Nike appointed Elliott Hill as the new CEO in October 2024. Hill has outlined a turnaround strategy focusing on strengthening retail partnerships, realigning with sports, and introducing new models. Despite these efforts, the company reported an 8% decrease in sales and a 24% drop in profit in the recent quarter. Analysts have a mixed perspectives, with some optimistic about a return to Nike's storytelling roots, while others remain skeptical due to strong market competition and loss of market share. Nike's challenges also stem from an over-reliance on a few shoe styles and a strategic shift towards direct sales, which has strained wholesale relationships. The company faces additional hurdles, including rising local brand preferences in China and the need to transition from cost-cutting to investment. So it's very important to see how this new CEO will perform over the next few years. But despite these challenges, some analysts believe that Nike's strong brand recognition, financial performance, and growth prospects justify its valuation. Not to mention the very strong 5-year dividend CAGR at over 9%, alongside that 22-year dividend growth streak, which is very reassuring for any dividend-focused investor. The company's commitment to innovation and sustainability, along with its global market expansion, are seen as positive indicators for future growth. In summary, while Nike is currently navigating significant challenges, its strategic initiatives under new leadership aim to revitalize the brand and improve financial performance. You should monitor the company's progress in executing its turnaround plan and consider both the risks and potential rewards associated with investing in Nike stock, but it is one that I personally think is worth that risk at these prices. If we have a little look at the 12-month Wall Street estimates, you can see that they back up what the analysts were saying, where some are cautious, but some are actually a little bit more bullish with the stock and believe that there is a good upside potential on this stock. When looking at the intrinsic value for Nike, we can see they're valued at $85.11, which is also a slight upside on that current price, so it could be a potentially good time to buy into this stock. The next stock that I believe is trading at a discount is Merck & Co, stock ticker MRK. Their current price is $98.28. They are based in America, part of the healthcare industry, have a market cap of $248.6 billion. They went public in 1946 and have a 14-year dividend growth streak, with a very nice 5-year dividend growth rate at 6.49% and a dividend yield at 3.31%. They have a healthy payout ratio still at 64%, and over the last 12 months we can see this stock is down over 19% and they are actually at their 52-week low. Merck & Co stock is a global pharmaceutical company known for developing medicines, vaccines, biologic therapies, and animal health products in over 140 countries. Investors in Merck & Co stock are typically interested in the company's performance in the pharmaceutical and healthcare sectors. As already shown, Merck is known for its solid dividend payments, making it attractive to income-focused investors. It also has a very healthy 5-year dividend CAGR, so arguably could be classed as a good long-term dividend growth stock as well. One of its most famous products is Keytruda, an immunotherapy drug widely used in cancer treatment. They also produce vaccines like Gardasil for HPV and Phenormax for pneumonia. Merck is committed to addressing global health challenges such as HIV and AIDS, malaria, and neglected tropical diseases, often through collaborations and partnerships. Recently, Merck has faced challenges impacting its stock performance. A significant concern is the impending expiration of Keytruda, its leading cancer therapy, in 2028. Keytruda accounts for about 40% of Merck's revenue, and the patent expiration could lead to biosimilar competition and potential revenue decline. Additionally, Merck reported a decline in demand for Gardasil, its HPV vaccine, in China, which contributed to a notable decrease in the company's valuation. However, to address these challenges and improve performance, Merck is implementing several strategies. The first one they're implementing is accelerated launch of new Keytruda formulation. Merck is releasing a new version of Keytruda aiming to maintain market share ahead of the 2028 patent expiration. The company plans to launch this new formula earlier than initially planned to facilitate a smoother transition and retain patient adherence. Merck is also actively pursuing acquisitions to diversify its portfolio and reduce the dependence on Keytruda. Notably, the company entered a $3.3 billion licensing agreement with Lenovo for a novel cancer drug aiming to bolster its oncology pipeline. And finally, their continued investment in research and development as Merck continues to invest in R&D to innovate and expand its product offerings, focusing on areas with unmet medical needs to drive future growth. By implementing these strategies, Merck aims to navigate current challenges and position itself for sustainable long-term growth. Right now, Wall Street believes that it is very much undervalued, and you can even see on the worst case scenario, they believe it still has a 2% potential upside, but on the average and best case scenarios, there is massive upside potential with this stock. Not only that, but to back this up further, we can see the intrinsic value of Merck & Co right now is sitting at around about $135, which would mean it is currently valued at 27% undervaluation. I'm really excited to announce that today's sponsorship is from none other than a really cool dividend tracking app called Snowball Analytics. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Rolls Royce of portfolio trackers. I have personally been using this app since the start of my investing journey, and I'm extremely impressed by how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and I find the platform very easy to navigate. Plus, it's packed with so many different charts and graphs to do all the hard work for you, so you can really understand different aspects of the portfolio. It not only dives deeper into your own personal portfolio, but also into individual stocks as well. Pretty much anything you want to know about a company's financials or dividend history can be found here within the Snowball Analytics app. In my opinion, what really sets Snowball Analytics apart from the rest is the features that it has designed specifically for dividend investors. This app tracks your portfolio so closely and has a very robust event calendar that shows you all relevant information you need to know about your stocks, as well as potential income coming in, and it predicts the income you are likely to receive in the future as well. Not only that, it adds total returns to your stock with the dividends you have also received, which no other dividend tracking app can do. This is so important as it can really show you the bigger picture and highlight how well your portfolio is actually performing. If you are interested, then please click my link in the description to check out Snowball Analytics. You can also get a free 2-week trial so you can try it out for yourself first and see if it's for you. Let's get back to the video. The final stock that we are going to be looking at today that I believe is undervalued in the market right now for February 2025 is Hershey Company, stock ticker HSY. Their current price is $149.43. They are based in the consumer industry with a market cap of $22 billion. They went public in 1985, have a 15-year dividend growth streak with a massive 5-year dividend growth rate at 12.88%, and also a very healthy dividend yield currently sitting at 3.67 with a very modest payout ratio still at only 59%. As you can see on the graph, this is also at its 52-week low, being down 22.79% over the last 12 months. The Hershey Company is an American multinational company best known for its chocolate and confectionery products. It was actually founded back in 1894 by Milton S. Hershey and has grown to become one of the largest chocolate manufacturers in the world. Hershey's produces a wide range of chocolate products, including iconic items like the Hershey's Milk Chocolate Bar, Reese's Peanut Butter Cups, Kit Kat, and Kisses. It also manufactures non-chocolate items such as Twizzlers, Icebreakers, Jolly Ranch candies, and also healthier snack options like Skinny Pop popcorn. I have to admit, a lot of these brands are a lot more well known over in America compared to us in the UK. Having said that though, Hershey does operate in over 80 countries, but is particularly dominant in North America. Its products are widely recognised and have strong brand loyalty. The company also runs the Hershey Experience, which includes Hershey Park, a theme park, Hershey Chocolate World, and interactive visitor centre. Hershey's has committed to using 100% sustainable cocoa by 2030 and is actively working on improving environmental sustainability, reducing carbon emissions, and supporting cocoa farmers. Recently, Hershey has faced several challenges impacting its stock performance. One of the main issues has been the elevated cocoa prices. The main concerns about this are that the high cocoa prices will persist, potentially impacting the company's earnings per share, also known as EPS, in the coming years. Not only this, but there have also been a noticeable shift in consumer behaviour towards healthier snacking options, which has impacted demand for traditional confectionery products, which are some of their best sellers. However, to address these challenges and improve performance, Hershey is implementing several strategies. One particular strategy that it is implementing is the Better For You, also known as the BFY production expansion. The company is committed to growing and expanding the BFY confection category by focusing on 4 key strategic priorities, including staying close to consumers to understand the new snacking habits and focusing on sugar reduction across its BFY portfolio. They are also looking to strengthen their supply chain through innovations like simple packaging, redesigning display cases to offer convenience, flexibility, and adaptability, therefore improving efficiency and reducing costs. Finally, the company is refreshing its sustainability strategy to build a more resilient cocoa supply chain, which remains Hershey's top sustainability priority and will be their biggest benefit long term. By focusing on these areas, Hershey's aim is to navigate current challenges and position itself for sustainable growth long term. Remember, Hershey still has so many iconic brands and still remains a leader in the confectionery industry. If we have a look at the 12-month Wall Street estimate, they do believe for the best part that it is likely to have an upside potential of around 18%, but some do believe there is a potential of a 10% downside still on that current price. And on the intrinsic value, you can see they are slightly overvalued right now, with my intrinsic value coming in at around $140. So if that price was to drop another $10 or so, it would be around about the intrinsic value price and would be more of an attractive price to potentially start buying in, but definitely one that I would have my eye on, with it being at that 52-week low. Are you going to look to add any of these stocks to your portfolio? Let me know in the comment section down below, and thanks for watching. If you're building a portfolio for passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. Please share your thoughts in the comment section and let's grow this community together. Until next time, keep compounding, stay patient because your future self will thank you. This is the Geordie Pig Investor, over and out.